Fantastic.
You're in. Oh,
Cool.
who's that guy?
Can you see it?
All right,
Fantastic.
you're in.
All right. So the first part of it, I'm just going to provide you with an overview of strategy and macro analysis. Um, a little bit about me first. So me, I have 10 years of experience in corporate strategy. I typically work in large publicly listed global organizations, and my role is to work with the leadership team to try and figure out what markets they should be in, what products they should build, what companies they should acquire, and help them formulate a strategy. My background is typically in consulting, so I kind of dip in either in a strategic consulting company that consults to a large company, or I'll go inside the organization. I'll play a functional role either in strategy, innovation, or new product development. My speciality is in technology. So, if you've been on Savvy Investor for a while, you'll know I'm an absolute geek. So I've got like, the VR goggles, the drones, pretty much most of the major gadgets I've got. Absolute geek. I grew up as a kid
Yeah,
watching the
okay.
Jetsons and watching James Bond. So between those two things, I'm absolutely addicted to gadgets. Around about 2015, my wife and I got to the point where we'd become financially independent. We're in our 30s. We'd paid off the mortgage. We weren't retired. Our kids were still relatively young. And so I took that opportunity to set up the Savvy Investor community with a very naive goal to help 100 people reach their first million. It's my very firm belief that once you hit your first million, the second million is an absolute piece of piss. The third million will be an absolute piece of cake. And after that, it starts to snowball. And if you can't retire by the time you hit 3, 4, or 5 million, then you're doing something wrong, but that becomes a choice for you. I'm extremely passionate about financial literacy, and I love teaching it, I love coaching it, and I love sharing it. And that's part of the reason why I'm here with you guys tonight. Okay, so one of the things that's really important to me is I want to make sure that I provide you guys with the tools to be able to do this yourself rather than just give you answers. So it's very easy for someone like ASX and I to be able to give you, you should buy silver, you should buy gold, you should buy Bitcoin. What I want to be able to do is I want to be able to give you the tools so you can spot these opportunities yourself so that after we go away, you guys can continue to extract value from the market and build a life and a financial future for yourself and your family. Really important to me, really important to ASX. Okay. The model that I'm going to walk you through today is a strategic model that consultants typically use with large organizations to formulate a strategy. The shortened version of it is called PESTLE, and it stands for political, economic, social, technological, legal, and environmental. It's a very easy framework to remember all of those particular elements. And what I typically do when I'm working with a client is I look at, well, if you're an organization that's working in industry, what all the things in the political framework that could impact your industry might be change in policy, could be a change in tax, could be a change in labor law, might be an increase in corruption, or what are the things that are affecting the economic environment that you're working in? Could be exchange rate. You might have like an awful lot of import and export. Could be interest rates. Could be inflation. And so each of these different elements from political, economic, social, technological, legal, and environmental, they're things that can affect whether an organization will perform well or not. This is kind of like the battlefield that creates opportunities and threats. How well an organization performs depends on its ability to capitalize on the opportunities and to mitigate those threats. Now, I'll make sure that ASX has a copy of these slides because there's too much information for you to be able to absorb this. But once you've got this, it's a really good framework for you to start applying it on specific examples. The next thing I do is the PESTLE model provides you with a framework to identify what the opportunities and threats are for the organization. Then you start looking at the company itself and you go, what are the strengths does this company have? And what are the weaknesses does this company have? And how are they positioned to actually take advantage of those opportunities? And how are they positioned to manage those threats? Some companies can do it better than others. Some companies like Nokia might lose the entire mobile phone market. Other companies like Apple might completely dominate the Apple market, sorry, the mobile phone market. So depending on the organization, what their capabilities are, it determines what their strengths and weaknesses are, and that determines how well they're going to be able to cope in that environment of opportunities and threats. Now, what are you looking for? So when I do some analysis of a particular industry in an organization, I'm looking for two things. I'm looking for changes that creates opportunities and threats that people may or may not have seen, or I'm looking for something that's trending and the impact hasn't been felt yet. And I'll give you some specific examples. Okay, so the first case study before we go on to and talk about silver, just to apply that model. So I'm old enough to remember Blockbuster. As a kid, I used to love Fridays because, on a Friday, we'd go out to the corner store, we'd go to the Blockbuster, we'd grab like an overnight video, we'd grab some pizza and we'd bring it home. Now, Netflix, Blockbuster and Netflix kind of coexisted during a period of time. A lot of people don't know that Netflix started its life as a DVD hire business. And so instead of going to a physical location, what you would do is you would select a movie from a catalog, you would order it, they would mail it to you, you would watch it, and then you stick it back in the envelope and mail it back to them. That's how they started life. So they were an alternative to Blockbuster. It wasn't until the capacity in the infrastructure and telecommunications became big enough that you could start to stream content online that they started to become a streaming business. They started off as a DVD business. If you look at the user experience of what the Blockbuster experience gave, it was time consuming to go visit the store. There wasn't a catalog. You could only pick what was on the shelf. The thing that I hated most about Blockbuster was the late fees. And so, a lot of the times I'd have a DVD that was a couple of days late and I wouldn't go back for months because I would refuse to pay the late fees. And I needed an expensive piece of equipment to play the VCR. And I had, that tiny little rewinder that everyone had that looked like a car that you stick your cassette in, you push it down and it would rewind it. That was the Blockbuster user experience. Now, if you can compare and contrast that with what you know today as Netflix, you can access it from your home. You get smart recommendations. So if you like Games of Thrones, it will recommend other shows that you would like. You only pay a subscription fee, and it's all you can eat. It's completely unlimited, and it's available from any smart device, not just your home. The user experience of these things were completely different. The thing in the Pesta model that made this transition possible was the T. It was the shift in technology. It was the commoditization of bandwidth. It made the Netflix business model possible, and it allowed Netflix to transition from a DVD rental business to a streaming business. Now, if you look at this chart, it didn't take very long from 2004 when Blockbuster was at the height of their game and Netflix was, still an early incumbent in 2004, for everything to change dramatically. Around 2012, Blockbuster declared bankruptcy. In 2016, Netflix was worth $8 billion. And the last time I checked, Netflix was a couple of $100 billion. A lot of people don't know that around about 2000, Blockbuster was given the opportunity to acquire Netflix for about $50 million, and they said no. They couldn't see, based on the Pesta analysis, the opportunity of what was coming. They couldn't see the massive investment that was made in the infrastructure in .com in this opportunity. What they could have done was either bought Netflix or they could have competed with Netflix. But because they were still stuck in their paradigm of their old business model of opening branches, having DVDs on the shelves, they become bankrupt. And Netflix basically just took off. So this is an example of how you look at these macroeconomic forces and you look at, well, who are the organizations that are best to capitalize on it? Now, the reason why Blockbuster didn't do this is because they were so wedded to their business model. If they tried to build anything that was a streaming business, it would basically cannibalize their franchise, and they didn't want to do that. Netflix, on the other hand, they had nothing to lose. And so their pivot from being a DVD rental business to a streaming business was quite easy, quite painless, and very, very profitable. So they had nothing to lose. Okay, so That's the PESTLE framework. We'll make sure that you get a copy of this slide so you can go through and systematically apply each of these different verticals to an industry to assess, well, what are the impacts and what are the opportunities and threats that those impacts will have for the specific company that you're looking at. In this case, it was certainly technology that drove that change. And it sounds like a relatively simple technology, but for Blockbuster, it was pretty mammoth. Okay, now before I go, I'm not going to go into energy. What I'm going to do now is I'm going to flip over to silver. Okay. Can you still see my screen? Oh, slideshow.
Yeah, we can.
Yeah,
okay.
we can.
Fantastic. Why silver? Okay.
It's shiny.
It's shiny. That's one of the reasons. Now, some of you might have seen the AFR article that I was in a while ago, and there were two asset classes that was pretty prominent in that article. One was gold, and one was Bitcoin. They're probably two of the two assets that I'm very bullish. The only asset that I'm more bullish than either gold or Bitcoin is actually silver, and these are the four reasons why. The first one is because it's an inflationary asset. And what I mean by that, sorry, let me get rid of that. What I mean by that is we're living in a period of time now where we've got inflation that's on the rise. You would have noticed every time you go to the grocery store that things are costing more. It's not just costing more for you, it's costing more for businesses. So when you think about the mining operation of silver, you have to pay staff more, fuel costs more, the cost of borrowing to finance your capital for your heavy industry costs more. So all of your input costs cost more. And as a result, in order for them to stay profitable, they have to increase their costs, they have to increase their margin, they have to charge more for silver. And so what silver is it's an inflationary asset. The second thing is historically, going back in time, for the last 5,000 years, it's also been a monetary asset. If there's anyone here that speaks Spanish, I'm really terrible with languages, but the Spanish word for money, one of the words anyway, is plata, which actually means silver. And so going back through an awful lot of history for the last 5,000 years, civilizations have used silver as money. And because gold is going up, gold is also a monetary asset. Silver typically follows gold, so silver also has an awful lot of tailwinds. Right now, the next reason is silver is historically it's really undervalued. It's undervalued compared to all of the other commodities. It's undervalued compared to gold. It's undervalued compared to the stock market. Right now, it's ridiculously undervalued. Macro investors are value investors. They love buying things that are hated, undervalued, that nobody buys. And what they do is they just have the patience to sit out and they wait for the rest of the market to understand and catch up. And the last thing is silver is a huge part of the green revolution. So all of you have some silver on you right now and you probably don't know it. Every phone has got some silver in it. Every car has got some silver in it. Every laptop has got some silver in it. It's required in laptops. It's used in solar cells. It's used in the solar panels on people's roofs. It's a huge part of the new electric revolution as we transition to more EV cars and solar powered energy. So they're the four main reasons why I'm going to deep dive into each one. So I talked about inflationary assets. So if you're looking at a mining company, a lot of the mining companies at the moment that mine silver, they don't mine silver as their primary commodity. They mine copper or nickel or gold, and they often get silver as a byproduct. But a lot of their costs are increasing. The energy cost is increasing, labor costs are increasing, the capital costs are increasing. It costs more money now to extract the commodity and move the commodity and transport the commodity and fabricate the commodity and get that into a bullion shop that turns it into a gold coin and makes it available for Matt. So it starts to get very, very expensive. And as a result, the costs go up, and as the costs go up, the prices go up. So in order for the mining companies to make a profit, they have to increase their prices. Now, If demand remains inelastic, and inelastic means demand doesn't change. If demand remains inelastic and it costs more to produce stuff, people will continue to pay higher prices for a commodity. So it's an inflationary asset. The last time we saw inflation rise was in the 1970s. So we've been in this golden age since the 1980s till now, where inflation has basically been trending downwards. But the last time was during the 1970s. We saw 3 impulse waves of inflation. We're currently right now in the first impulse wave where it's on the downturn. We don't know yet whether or not we're going to get a second impulse wave. It depends on how governments around the world actually respond. And if they continue to print an awful lot of money, we're going to see the second impulse wave of inflation, which will be good for inflationary assets. How do I know? Let's look at the price of silver in the 1970s. So if you go look at the chart on the bottom left-hand corner, you'll see what the price did from the 1970s. It did a massive spike up from 1970 to about 1974, but then it did an even bigger spike from 1975 to 1980. It did that for a couple of reasons. The first reason is because silver is an inflationary asset. The second reason was there was 2 Texan billionaires that managed to convince a Saudi oil from the Saudi oil family to basically buy all of the physical silver around the world. They literally had a monopoly on all of the physical silver. And because demand was relatively inelastic, as I mentioned before, the price just absolutely spiked. What it took was the government to intervene, and they basically stopped the purchase of silver. You couldn't buy future silver contracts anymore. The only thing that you could do was sell, and basically it basically took down the Hunt brothers. But that was an amazing bubble, and you know it was a bubble because we didn't get that price again for another 30 or so years, and it took quite a long time for it to recover. But the 1970s was the last time we had a major inflationary impulse. Silver is an inflationary asset, and this is how silver behaves. It behaves like an altcoin in an inflationary cycle. Now, the second reason I mentioned was silver has a deep history of being a monetary metal. So these are various coins that go all the way back to, what was it, 158 BC in ancient Greece in the top left-hand corner, and just to the right of it in the Julius Caesar Roman age of up to 350 to 355 AD, all the way to the modern day. So the bottom right-hand corner, you see a George VI silver coin for 1937. America still had the silver dollar up until the 1960s, and then they stopped using silver for making coins because it became too expensive, and they started using much cheaper basic coins like tin and copper. But for the last 5,000 years, silver was a monetary metal. Now, this is a curious story. My wife and I were in Egypt last year, and we went to this display. It was in a museum in Cairo, and the sarcophagus of one of the pharaohs was entirely done in silver. And there was a plaque on the wall that says this was the wealthiest pharaoh basically in Egyptian history. And I wondered to myself, why the hell is the sarcophagus encased in silver and not gold? At the time in Egypt, gold was readily available. You could pick it off the ground. There was large nuggets. It was relatively available. It wasn't scarce at all. Silver, they had to dig for. And so at that particular junction in history, silver was more expensive than gold. So that's just a curious story. The way that silver behaves, it behaves half like a commodity. I mentioned before that, it's mined, it's used in industry, it's used in solar panels, and it behaves half as money. And so when we want to analyze where silver is going to go, you actually have to look at both traits to give you an understanding of where the supply and demand is going to pull. Okay, it's going to move with gold and it's going to move with commodities. Now, the good news is right now we're in a gold bull market and we're also in a commodity super cycle. So both those things are bullish for commodities and gold, which means it's also bullish for silver. if you look at where silver is used globally around the world, 33% of it is used in industry. It's used in the phones that we've got, the plasma TVs that we've got. It's used in pretty much all of the electronic devices we've got that surrounds ourselves. 27% is actually used in physical investment. That's like bullion that's held by wealthy people. 90% is used by jewelry. 11% is used in solar panels. That's that photovoltaics line. 11% is used in solar panels. Now, if you know anything about solar panels, the demand curve for solar panels is going ballistic globally. It's going absolutely ballistic globally. Now I've got somewhere, where have I got it? Here. I'll skip ahead a little bit. The World Bank forecasts that by 2050, the consumption of silver for energy technologies, such as solar panels, could grow to a level that's 50% more than the current total silver demand. That's the largest for any non-battery metal. So think about that 11% line again. Let me go back here. That 11% line, the demand for that by 2050 is going to be more than everything that's on this page, and 50% again by 2050. The demand for solar panels and photovoltaics is just going gangbusters. So generally, you know that when demand increases, the price increases. Now, I want to walk you through the macro pattern. How does silver behave? So this is the chart of silver and gold. It goes all the way back to 1974. The red line is silver. The gold line is gold. Now, you'll notice that they tend to follow each other, but there are points in time where there's divergence. That blue bar is where there's divergence. So gold and silver, if you look at the 1970s in the bottom left-hand corner, gold and silver tracked together. You can't see it because it's so long ago, but there's a tiny little bit of divergence that starts to form in 1977. And then what happens? Silver overshoots gold. So if you think of gold as like Bitcoin, silver acts like an altcoin. Gold tends to move first, and then silver overshoots it in the second half of that bull cycle. And then again, happens if you follow that line, the date back to 2008. Again, gold is ahead. A divergence starts to form. There's a big gap between gold and silver, and then silver overshoots in the second half. So where are we now? We're in 2024. Gold has hit all-time highs. Silver is still 40% below its all-time highs back in 2011. So that divergence is forming, and it's my expectation that silver is going to overshoot in the second half. So that's the macro pattern between gold and silver. Now, I mentioned before that silver acts as two things. It acts as a commodity, and you saw here that as a commodity, there's bullish forces that's going to push it simply because of industrial application and solar panels. And here it acts like money, and there's bullish forces behind this because the world's printing money. There's two regional wars in the Ukraine and Gaza. Gold's hit all-time highs, and silver is going to follow. Okay, now the gold to silver ratio. You get the gold to silver ratio when you take the price of gold and you divide it by the price of silver, and that gives you a ratio. And what that allows you to do is over time, it kind of allows you to tell what's more expensive and what's cheaper. And so if you look at the ratio over time, like it's ranged everywhere, like from 3,200 BC, 2.5. What that tells me is it takes 2.5 ounces of silver to buy 1 ounce of gold. So right then, silver back in those days was very overvalued. And if you look at the bottom right-hand corner in the 1700s, it took 15 ounces of silver to buy 1 ounce of gold. So historically, the range has been around about 10 to 15, historically, in the last, God, what's that? Nearly 5,000 years. In more recent history, the ratio has changed. So this is the gold to silver ratio that's going back to the 1920s. That ratio is now, like if you drew a line that's roughly a line of best fit there, it's probably going to be about 55 maybe 60. And right now, the ratio is over 70. So what that tells me is silver is relatively cheap. So whatever the line is above that 55 or 60 average, it tells you that silver is cheap. You want to buy silver. When the line is below the average, below that 55 line, it tells you that gold is undervalued relative to silver, and you want to buy gold. So we talked about silver being undervalued as a commodity. We talked about silver being undervalued as a precious metal, and here we're showing that silver at this particular point in time is undervalued relative to gold. The other thing that I started to see in the market, if you followed the Wall Street bets and the AMC short squeeze, that's where a whole bunch of retail investors start to short squeeze hedge funds by buying up shares in AMC. What I noticed, this would have been, I think it was 2021. Was it 2021? January 20? No, January 23. No, I don't have the year here. I think it was 2021. I started to see an increase in the Google searches for silver short squeeze. The silver short squeeze search is that blue line there. And at that particular point in time, the AMC short squeeze hype had kind of like ramped down. So it kind of like, you can see the AMC short squeeze line, which is the red line, was ramping down. And then people were looking at, well, what's the next thing that we can short? And that's silver. Now, Matt asked me a question really early on, like, Tung, do you own physical silver? And my answer was, yes, I do own physical silver. And the reason why is when there's a short squeeze that happens, people are going to realize that there aren't enough actual physical pieces of silver for every ETF that they have, for every futures contract that they have. And then all of a sudden, there's a price gap that emerges between the spot price and the physical price. And here's an example. So on the left-hand side, you've got the price of silver in spot, which is about $24. If you try to buy a physical ounce of silver, just if you look at the table on the right-hand side, if you bought between 1 to 19 coins and you try to pay by a check or a wire, which is basically just a bank transfer, you'd have to pay $40. That's a massive gap for an ounce of silver. And that typically happens when there's so many claims on physical silver, but there actually isn't enough physical silver available. If everyone at the moment in the world tried to claim their silver, there wouldn't be enough. It's like a game of musical chairs. Okay, now we mentioned before that silver was relatively undervalued. The entire commodities industry is undervalued at the moment relative to equities, and you see this from the commodity to equity ratio. So typically, when the line is, I'd say probably below 4, what you want to do is you want to go into commodities, and anytime when the line is like above that, you'd want to get out of them. The gold to silver ratio we'd spoken about already. Silver, there isn't any other metal that I can think of that is still below its 1980 high price. It's like 40% below its record high price. So silver is ridiculously undervalued to commodities, which is already undervalued, and to gold, which is undervalued, and both of those things are climbing. I've spoken about this, which is the demand for energy consumption and solar panels. And the thing that I've noticed now is there's headlines that are starting to emerge that makes the conversation around silver more mainstream. Because if I go back to 2015, when I first started to get interested in this, and we bought a sizable position in silver, it was just geeks like me and macro investors around the world that were going, this is really bizarre. Why is this one metal so undervalued compared to everything else when the demand curve is so strong? There wasn't an awful lot of people talking about it. It was just geeks and gold bugs and silver bugs. But now we're starting to see news articles, not just talking about gold, but talking about silver. And we're seeing headlines like this, like silver surges as retail investors take aim. This is a chart of, okay. So this is a chart of total balance. So if you take the total amount of silver that's manufactured every year, and then you minus from that all of the ounces of silver that are actually consumed, that gives you the net amount. Typically, if you look at 2014, 2016, 2017, you manufacture more than you consume, yeah? But what we found recently, since 2022, the consumption of silver, the demand for silver is so huge. We're consuming like nearly 8,000 tons more than we're actually producing. And so what that means is there's a shortfall that had to find somewhere. So that's coming out of reserves. The demand curve for silver is phenomenal at the moment. And when you look at where the supply comes from, these are the countries of the top 10 silver producing countries in the world. Some of them are, at risk of geopolitical problems, like Russia's in problem. China is problematic. And Mexico, which is the largest manufacturer that manufactures more than 20% of the silver, they're facing a shortage. And so the world's largest manufacturer of silver is facing a shortage of supply. Now, when I think about macro, everything boils down to two things. It boils down to demand, it boils down to supply. And everything that I'm seeing here in terms of the shortfall, the production countries, what's happening in those production countries, just tells me that there's a massive tidal wave of bullish forces around silver. And what does that look like? So the demand curve is the orange line, the supply curve is the blue line, and so there's nowhere else but for silver to go up. It's inevitable. It's just a matter of time. I don't know when, but when it breaks, it's going to be pretty ugly. And not only will it be ugly, but the vast majority of silver is owned in the form of futures contracts. You can't build solar panel with futures contracts. So when they actually need the silver to put into the solar panel, to put into your iPhone, to put into your tablet, you're going to need physical silver. And so what's going to happen is the spot price might do something, but the price for physical silver will pretty much jump up. There's going to be a massive gap between those two prices. Okay, so there, and I think this is my last slide. Yeah, last slide. A lot of you from your technical analysis would be familiar with this chart. This is a ridiculously long, I think 40-year span of a cup and handle. It is the largest cup and handle I have seen in my life. At first, when I saw this, I thought, I don't know if there's a statute of limitations on cup and handle formations, but I checked with ASX and it says, no, it still holds true. Doesn't matter how long it is. And so when this blows, it's going to be fantastic to watch. So I started this with, why silver? I shared with you why it's an inflationary asset, how it's a monetary metal, how it's historically undervalued, and why it's part of the green revolution. And that's why I'm excited about silver. Now, the last thing I wanted to share with you is this video. How do I make sure that I'm going to play the video? Let me know if you can hear the sound. Is the sound coming through?
No, it's not. I think you got to share. When you share, you have to share with the sound as well.
Okay, let me
It's
share it again. Let me share it again. So share screen.
At the bottom, there's an option called share sound.
Share screen. Yep. There's a bottom share sound. Very good. Thank you. Okay, let me play this. Now, the reason why I like physical silver is because at some stage there's going to be a break between the futures contracts and the physical silver. This is a short interview with Kyle Bass. Kyle Bass is a Texan billionaire. He was one of the few people that picked the global financial crisis and he shorted the market. I think from memory, he made about 500 million from the global financial crisis when everything else went to shit. And he's going to describe for you what happens in a short squeeze when they can't find the physical metal. He's referring to gold, but the same thing applies to silver.
Kyle, can you talk a little bit about gold and why at UTIMCO, why at UTIMCO you actually took delivery of the actual gold?
So I'll give you my opinion. I won't speak on behalf of UTIMCO.
Sure.
So my opinion is very simple. As a fiduciary, which I am in that position, to the extent that you own gold and you are going to own it for a long time, it's not a trade. It costs us about 90 basis points a year to roll it through financial futures contracts. And then we went and looked at the COMEX. So the COMEX at the time had about $80 billion of open interest between futures and futures options. And in the warehouse, they had 2.7 billion of deliverables. So 80 billion of open interest, 2.7 billion of deliverables. We're going to own it a long time. You're on the board, you're a fiduciary, what do you do? Like, that's an easy one. You go get it. All right? So you go take $1 billion of the 2.7 billion and let them worry about the rest. Mm-hmm. And when I talked to the head of deliveries for COMEX and IMEX, I said, well, what if like 4% of the people want delivery? And he says, oh, Kyle, that never happens. We rarely ever get a 1% delivery. So, and I said, well, what if it does happen? And he says, well, price will solve everything. I said, thanks, give me the gold. And then what was interesting was we conducted an audit of the delivery. And what was interesting in the audit was they kind of resisted our audit request on the front end. And then they finally allowed us in. And we did a random audit we had like 1,600 bars or something like that. And we just wanted to see 20 or 30 of them. And they were all over the place in different venues in the vault. They weren't segregated. So yeah, it's an interesting concept. But what I'm saying is the exchange is a fractional reserve exchange, and they think price will solve everything. So I mean, that was a decision. It's actually an easy decision if you're a fiduciary.
Okay. I'm back. So those are the slides that I had for you. Eventually, when I get my shit together, I am going to put together a macro course so that you can go through and dissect a sector and an industry and spot opportunities like that, and go through and think the way that I think and find those opportunities and narrow it down and go, well, shit, this is one of those opportunities of a lifetime. It's going to explode. You don't know when, but when it does, it's going to be absolutely fun to watch. So other than gold and Bitcoin, this is probably one of the most exciting things that ASX and I